Investing is one of those roads lined with both golden opportunities and pitfalls, so treacherous they'd make Indiana Jones sweat. Let's break it down to brass tacks. Diversify, but not too much. I once heard someone compare diversification in investing to ice cream. Have too little of it, and you're left unsatisfied. Have too much, and you'll end up with a stomachache. This is about right. You want a portfolio wide enough to spread risk, but not so wide that you can't keep track of your investments, or that you dilute your returns to nothing. Understand what you invest in. This is no minor detail, and Warren Buffett hammers on it all the time. If you don't get it, don't put your hard-earned cash into it. That means understanding the business model, the market, competitors, and the long-term viability. I mean, you wouldn't buy a car without knowing if it's got an engine under the hood, right? Risk management time in the market beats timing the market. That's the gospel. But also know what you can afford to lose. This isn't Vegas, but you shouldn't bet the farm on something that might not come back home. Allocate your assets based on your risk appetite. Younger investors' portfolios can look like they're into extreme sports, high risk, high reward. But as you move towards retirement, you'll want to shift to more reliable stocks, bonds, and funds that are the equivalent of a warm cup of milk before bed. Keep emotions at bay. Ever tried to thread a needle during an earthquake? That's what it's like investing based on emotions. Markets will test your nerves. When they drop, it's easy to panic sell. On the flip side, when things look greener than the Willamette Valley in spring, you might be tempted to overbuy. Stick to your strategy. Automate if you have to. Invest in yourself. Sounds like a platitude from a self-help book, but hear me out. Educating oneself is probably the highest ROI you'll get. Knowledge aids in discerning good advice from bad, which is crucial since everyone seems to have an opinion about where you should put your money. Watch the costs. Overlook this and you're stepping over dimes to pick up nickels. Those management fees, transaction fees, and whatnot can eat into your portfolio like a hungry beaver on a sapling. Keep your costs low where possible. Compounding works both ways, unfortunately. Long-term vision. Invest like you're planting a tree under whose shade you don't intend to sit. Long-term strategies often yield better fruit because markets tend to go up over time. Short-term investing can work, sure, but it's like catching raindrops in Portland. Unpredictable and often leaving you drenched. Have a plan and stick to it. Make your plan and work your plan. Adjust it if life throws you a curveball. A new job, a baby, a move from Portland to who knows where. But always have one. Without it, you're a rudderless ship in the mighty Columbia, likely to wind up in the Pacific without a paddle. As for achieving your goals, investing is not a guarantee, but rather a tool that, if used wisely, can help you build a bridge to your financial aspirations. Stay patient, stay informed, and maybe, just maybe, you'll find yourself in a place where the goals you once had are just the starting point for even greater achievements.